Hi guys, it's Dr. Robinson. Today is the October 7th meeting, October 7th, 2022 meeting of the Money Masters Investment Club. Before we get into the details of the meeting, the meeting's going to be relatively short this week, guys. I'm still not up to speed fully after the hurricane, but I did want to mention that I really appreciated some of the comments I got from you folks when we were going through the storm. A lot of prayers and emails and text messages and stuff, and I appreciate that. That was very nice of you, and from the bottom of my heart, I thank you for that. So we came through the hurricane okay physically, so no injuries, no nothing like that. My sister has had some pretty extensive damage to the roof of her house. The insurance company is repairing that as we speak. She also had some damage to her bird cage that goes over her swimming pool. And they're going to get onto that after they get her roof done. I wasn't as lucky. I had severe damage to both properties that I have there in Florida. Um, so I'm not going to be able to live there for quite some time. I'll be traveling to, I do have a place in Virginia. I'll be traveling to and from Virginia, back and forth to Florida from time to time, meeting with insurance claims adjusters to settle claims and all that sort of thing. So keep us in your prayers. Looks like life is starting to slowly get back to normal in Florida. We didn't get hit as bad as many. Many have nothing else to go back to. At least I have the structure of a home I can go back to, and I've got a lot of flooding, but some people don't have that. So keep them in your prayers as well, guys. It's a mess in Florida, but we'll rebuild. Almost everybody there has got some insurance, and we will rebuild, and life goes on. So thank you for the comments and your prayers and all that. It was greatly appreciated. Having said that, let's talk about the markets and the investment club and what we're doing here right now. Again, I did mention it by contact information there on the screen, richrobinsonphd.com and then rich.robinson.phd@proton.me. So itinerary pretty quick this week. Not going to spend a lot of time on a video. There's just not that much to do simply because I've been limited in what I can do. Just going to talk about financials and a little bit of market volatility. So in terms of the financials for the week, nothing to write home about. Trading has been very, very limited this week. I do fully expect to get back to full-time trading next week, starting Monday. So we'll have some better numbers coming forth Monday. Should have most of the stupid stuff that we got to get out of the way, getting computers and getting online and all that sort of stuff. We should have that all worked out by Monday of next week. So for this week, since Thursday of last week, of course, we didn't trade any at all the previous Thursday. We were in the midst of the storm. But from the 29th, and I just noticed the ending nav. I've got the wrong date on there. That should be 10/7. We did gain 21 cents in the little bit of trading that I did do. I apologize for the typo there, but ending nav's 23.14. That should be today's date, 10/7. So the gain was just a little less than 1% for the week. So all in all, given the muted amount of trading I've done, the lack of ability to trade significantly, overall pretty pleased with it. Given the limited amount of trades I've been able to do. I do want to caution you that normally this is the meeting that I would give you the quarterly results. I don't have those yet. Our accountants are in Orlando, Florida. They're back up and running again now. They just got power a couple of days ago. I still need to give them a couple of days to get back to work and back to doing all the things that they do. So we'll probably not have the real numbers or the quarterly results for a few days. I expect the accountant there is named Mark, and had a conversation with Mark, and Mark said that we'll probably have the numbers Monday or Tuesday of next week, but I'll certainly have the net results by our meeting next Friday. So everything should be back to normal by the end of week next week. I'll have a full week to trade, and we'll have our quarterly results, and we can kind of get back down to business and doing all the things we're going to do. But we did start the week at 22.93, added only 21 cents to the fund, 23.14, just a tad less than 1% for the week. So nothing to write home about, but at the end of the day, some of us don't have a home anymore to write home to. So at the end of the day, it is what it is. Um, just to kind of keep up with some of the things we've been watching, and there was a question, and I think it was actually a pretty good question. There was a question on the Facebook channel about, is it time to get back in the market? Um, now, I've been away from the trading a lot. We did have a rally. There seemed to be some sort of relief rally that started last Friday while I was still in Florida dealing with all that stuff, and then it kind of carried over to Monday and Tuesday of this week, and then Wednesday and Thursday kind of it wasn't great. The markets were kind of mostly neutral. They didn't really go up or down that much. They tended or trended down a little bit. But one of the questions was, do we think that because that rally, that Friday, Monday, and Tuesday rally, it kind of looked like the markets were trying to make a solid comeback? And the question was, is it time to get back into the market? Um, I'm pretty adamant right now. I don't think it's time to get back in the market. There's certain things I'm looking for to decide whether to get back in the market. And what I thought I would do is in this video, since I don't have a lot of trading information to talk to you about, I thought I would just tell you why I'm not necessarily convinced that this is the time to get back in the market. The first is, of course, the interest rates. So if you'll notice the interest rates now, again, we didn't have a meeting last week, so I don't have last week's numbers. But we go back to 9/22, which is the last time we had a meeting, and we look at today's numbers. And again, these numbers were effective as of about 1 or 2 o'clock this afternoon. But the one-year Treasuries jumped 10.1 basis points up to 4.181. Not a huge increase. It is an increase, but you think about it, it's a one-year bond paying 4%. For a bond investor, that's a good investment. There's no way to lose any money there, and you're guaranteed a $40 for every $1,000 you invest. You're going to get $40 in interest, guaranteed by the federal government. And I tell you, old people love those, or retired folks love those things. It's a very safe bond. Now, keep in mind what I've been telling you all along. As long as these interest rates on these very short treasuries, the 1 year, the 2 year, the 3 year type thing, as long as these interest rates are staying this high, that's going to keep a lot of money out of the stock market. Remember, seniors got a lot of money to invest, but if they can get guaranteed 4% over the next 12 months in a 1 year bond from the federal government, they're going to take that over and above putting, maybe $1,000 investment into Apple or to Microsoft or to Amazon or some other stock. There's just too much risk there. Those stocks could continue going down, but at the end of the day, how much, the value of a bond, a 1 year bond, still going to be worth effectively $1,000 a year from now. So there's no risk of loss, and you get $40 in interest. So it's kind of a no-brainer. I don't think there's any money going to be flowing into stocks as long as interest rates stay this high. Now, going back to what I just said a little bit ago, somebody asked about, hey, there's kind of a rally going on. What's going on with the rally? Well, early or late last week and then early this week, we saw a rally in the bond market. So the bond, and remember, when you see a rally in the bond market, that means the interest rates will be going down, because when a rally, the prices go higher. And remember, bonds are inverse to each other. So, or I should say, bond prices are inverse to interest rates. So as the bond price goes up, interest rates go down. And that's what we saw last week. Now, it was for reasons other than economic in the United States. It was basically the Bank of England defending its currency. So they had to defend their currency. They had to do some things with the gilt, which is a British pound. It's very similar to a treasury that we have here in the United States. So they had to defend their gilts and things. So in order to do that, they had to take some steps that kind of pushed the U.S. dollar down a little bit. Now, one of the things we're going to talk about here in just a moment is what's going on with the US dollar. But as the dollar comes down, treasuries or interest rates might come down a little bit too. So they did come down, and that's what spurred that rally Friday, Monday, and Tuesday. But the dollar kind of stalled. It stalled on the decline and is actually starting to hedge back up again. So as it continues to climb, that's going to force interest rates to continue to climb as well, which means the value of those bonds are going to go down. So the rally in the bond market was kind of a cool rally for 3 days, but it was a 3 day bond rally that kind of spiked the stock market. but at the end of the day, it couldn't hold, and I didn't think it would have held either. Now, of course, without electricity and stuff, I wasn't able to see everything all the time when it was going on like that. But a good portion of that rally was just simply what was going on in the currency market as opposed to kind of the stock market type thing. So it wasn't a rally in stocks based on economic, any kind of good news coming out of the economy. There still isn't any real good news out of the economy. In fact, today, if you noticed, we had kind of a sell-off in the market, and that was spurred on by the employment numbers we got today. Now, normally we like to hear good employment numbers. We like to see the unemployment rate come down, and it did. But I kind of, if you're on the morning call or the daily call with us, one of the things I've been telling folks is that right now we're kind of in a strange place in the United States where good news is bad news and bad news is good news. So a lot of investors were looking for bad news in the employment number. They wanted to see a lot fewer jobs created. They were expecting, economists were expecting 275,000 new jobs for the month of, remember, these are month lagging indicators. So this was for the month of September. So in September, economists were hoping for 275,000 new jobs. They only got 263, so it was a miss. But the unemployment number actually went down. And when the unemployment number went down, and then of course wage pressures kind of went up as well, that was, normally that would be good news. That means employees are making more money, and if you're making more money, you can spend more money, and of course that helps the economy. But right now, we don't want that because, the thing that's driving the Fed right now is inflation. And if employees are making more money, they're going to spend more money. And if they're going to spend more money, that makes inflation a little bit harder to tame. So that kind of makes it look like we're going to have another interest rate increase. Over the last few weeks, we've been hearing a lot of rumors that people say, well, the Fed doesn't really have to raise interest rates anymore. Back in 2008, now I didn't probably know many of you back in 2008. There's a few of you I did, but in 2008 we went through the financial crisis, and one of the big things that we used to say about the financial crisis is don't fight the Fed. And what we meant by that is if the Fed, and the Fed, by the way, back then was doing the opposite of what they're doing today. They were lowering interest rates. And economists thought that the United States kind of needed to go through a recession. We were in a recession through the 2008, 2009 cycle, but we needed to let it bleed off a little bit more. The government had spent a lot of money. They had printed a lot of dollars. And we needed to bleed that off a little bit. But Ben Bernanke, who was the Fed president at the time, or the Fed chairman, he kind of he kept doing what they had been doing. He kept pumping more and more money into the economy. And we kept saying, at some point this is going to be inflationary. But his argument at the time was, well, right now we can't worry about the inflation. We got to worry about the economy because we were, and he was right to some extent. We were on the precipice. But at the end of the day, he printed so much money that he kept making interest rates go down. So even though people said stocks are too high here, we're creating a bubble. At the end of the day, we said don't fight the Fed. If the Fed is going to continue to pump money into the economy and into the market, you just got to keep buying stocks. So, and we had that old saying, buy the dips. Every time you had a dip in the market, you just buy more stocks because they're going to come back because the Fed was putting so much money into the market. And during that time, we just simply said, don't fight the Fed. Well, right now, those same bulls who said, don't fight the Fed back in 2008, 2010, 15 stuff, those same people now are trying to fight the Fed. What they're trying to do is they're trying to get these rallies going based on what they think the Fed should do instead of what the Fed has told them what they're going to do. The Fed has been very clear. They're not going to stop raising interest rates until they get the Fed funds rate up into the mid fours. Now, whether it's going to be 4.25 or 4.5, some people argue it might hit close to 5. Don't really know. But at the end of the day, right now, we're at 3.5. So no matter how you look at it, we're probably going to see another 100 basis points between now and spring of next year. And it could be even higher, especially because those inflation rates are still stubborn. Now, we get some new inflation numbers next week. We get the CPI numbers. Maybe it'll show a little bit of a taming. But as of right now, all things being equal, interest rates are going to still go higher. As interest rates go higher, there's just no way that there's going to be a sustainable rally in the stock market. So the people who always told us back in 2008, 2010, 15 and stuff, don't fight the Fed, they're trying to fight the Fed right now, but don't buy into it. We can't fight the Fed. The Fed is, until the Fed tells us they're not going to allow interest rates to go any higher, or they're going to start, increasing the money supply, because that's how they actually manipulate the interest rates. If they start increasing the money supply, that's different. We'll jump headstrong into stocks, because of course you throw all that money into the market, it's got to go somewhere, and a good portion of it's going to go into the stock market. So we'll jump back into stocks when we see that happening, and of course once that happens, we'll start to see these interest rates start coming down. So while interest rates are going up, don't worry about any of these head fake rallies that are going on. They seem strong at times, by the way, but at the end of the day, they're not sustainable, because money's expensive. And remember, if you're a company like Apple or Microsoft or General Motors, it's costing a lot of money to borrow. You might see that in your own business, by the way. Some of you are business owners. And if you had to expand your operations, you had to buy new computers, you had to hire new people and all this stuff. With all of the extra expenses, that's going to cut into your profits. And remember, stock prices, and I've preached this from day one, stock prices always follow earnings. If a company's earnings are falling, their stock price is going to fall. Look at what's happened to Apple. Just a few weeks ago, they were back up to 480 or 470. They're back into 470. I'm at 180, 170. They're back in the 140. I haven't seen their price today. I haven't looked at it, but they're in the 140 range. It's coming down because they came out and said, listen, we're just not selling as many iPhones as we thought we would. We're not selling as many iPads and stuff because those things are getting expensive, and they're having to raise prices on things. Now, they try to keep prices intact in the United States, but if you had bought an iPhone in Europe or something, the price increased by about 11 to 12%. That doesn't sound like a lot, but that's $1,000 phone anyway. So you raise it 1,000 or 10% or something, you're adding an extra $100 to the price of the phone. And there's some people just simply say, "I'll buy it at 1,000, but I'm not going to buy it at 1,100," type of thing. So especially with what's going on with the euro too, and that's not something I'm going to get into here because it's too much on the forex. I don't want to bore you guys to death on forex stuff, but the euro is weaker against the U.S. dollar, which makes our stuff more expensive to them. Just on the exchange rate, and that doesn't even count the fact that we're raising prices for iPhones in and of itself. The fact that we raise the price of an iPhone by, let's say, 10%, $100. When you look at the currency devaluation, where the British pound used to be 160 or 170 the U.S. dollar, and now it's at 110 or 113, and the euro, which historically has been 120 against the U.S. dollar, and now it's at I think the last time I looked it was at 97 cents. So the euro is actually below the value of the dollar. Now that's more an issue of the rising U.S. dollar as it is opposed to European issues, but still it makes our stuff more expensive in those other countries. Having said all that, the 2-year Treasury 4.299, 3-year 4.238. If you look at that, by the way, the 1 year to me would be the most important because, again, if you're an investor, you don't want to lock up your money too long. You might go out to a 2-year bond. Probably not going to go out to a 3-year bond because there's not a whole lot of difference in the interest rate. In fact, the difference between a 2-year bond and a 3-year bond is a negative number. You'd actually make more money on a 2-year bond than you would on a 3-year bond because it's inverted. So at the end of the day, we don't, my expectation here is if you're an investor, you're going to buy that 1 or that 2-year bond at most, and you're going to leave the other bonds alone unless you're a long-term investor. And by a long-term investor, you're looking out 10, 15 years. And you might be interested in a 30-year bond or the 10-year bond. But for elderly, retirees and stuff, they're looking at those 1 and 2-year bonds. As long as those rates stay at these levels, the stock market is not going to come back up. All right. The 6-month bond, by the way, look at that 6-month T-bill, 4.09. So you can make more, $40 a year just on that, and it's just actually $80 if you redid it. You can make $80 on a bond that it's just amazing. And I said that wrong. It's not $80, but a $40 return on that bond, it's phenomenal if you think about it. In any event, mortgage rates you'll see up the upper left-hand corner, 30-year fixed rate. They had top 7 while I was in Florida. I did see that. They've come back down a little bit, but they're at 6.98. Again, that's just fundamentally too expensive for a lot of homeowners, especially millennials. So they're just not going to be buying houses that much. So we're going to continue to see housing prices come down as mortgage rates go up. And even the 15-year mortgage is now above 6%. It's the first time in a long time we've seen a 15-year fixed mortgage uh, cross over the 6% handle there. But as interest rates continue to go up, assuming they do, stock market's probably pretty incapable of generating enough steam to, uh, to form a bottom here. So I don't think we're at a bottom. I've been talking about the U.S. dollar, and to kind of put this in perspective, now a lot of people, and I don't trade the U.S. dollar, guys. It's not something I have any interest in. There's a lot of risk in that market. Um, but at the end of the day, the dollar kind of controls a lot of things. The value of the U.S. dollar. The dollar is the U.S. or the world's reserve currency. Remember, if you're a country, I don't care what country you are, if you're going to buy oil, you have to pay for it in U.S. dollars. So that's why we call the dollar the petrodollar. But it's also true of most commodities. You want to buy flour or corn or pig's feet or pork bellies or corn and all that stuff. You're going to pay, you buy that stuff in US dollars. So as the value of the US dollar increases, that puts pressure on foreign countries. And it makes their stuff more expensive. For example, if I don't care, again, I don't care where you live. If you live in Korea and you want to buy corn, you're going to have to pay more for the corn because the US dollar is more valuable, even if the value of corn fell. So the value of corn could fall down maybe from, and I'm just going to make up numbers just to kind of give you some illustrations, but maybe the value of corn goes from $4 a bushel down to $3.80 a bushel. So you think, well, the price of corn's coming down, so I should be able to buy more of it. But if the US dollar is going up, and I'll show you in just a moment, the value of the dollar is going up 26% or 28% or something. So as the value of the dollar goes up, it still takes more Korean won, that's their currency. It takes more Korean won to buy that corn. So countries are starting to get really hurt economically because of the value of the dollar. Now, the value of the dollar is going up for a couple of different reasons, but the primary is because of our interest rates. As our interest rates continue to climb, the world is going to continue to want to buy dollars. So they buy dollars and buy dollars. Now, the reason they do that for a lot of different reasons, but think about this. If you're an investor in Germany and the Bank of Germany, the Deutsche Bank, only pays you 1% on a bond, on a 10, let's say a 10-year bond pays you 1%, that's $10 a year. Well, instead you could transfer that money over to the United States and buy an American bond and get 4%. You're making $40 a year in interest. Wouldn't you rather do that? Well, when you do that, you have to convert your dollars or your euros into US dollars because we don't sell those things in euros. We sell them in dollars. So you have to convert. So as more and more people convert their things, their investments or their savings or whatever into US dollars, it just drives up the value of dollars. Remember the old thing about supply and demand. The more that somebody wants something, the more buying of something goes on, the higher the price of that thing. Well, the dollar is a thing too. It's just a commodity. So as more and more people want to buy the US dollar, the value of the dollar goes higher and higher. Now there are problems with that. The dollar going up does a couple of things. Number one, it hurts the rest of the world in terms of buying our stuff. They're not going to buy our stuff. So American commodities become too expensive. So they're not going to buy American, people in different countries, whether it's Europe or Asia or wherever, they're not going to buy U.S. motorcycles. They're not going to buy U.S. cars. They're not going to buy any of that stuff from us simply because they cost too much. Um, so when they convert their, let's say, Korean won or the Japanese yen into a US dollar or even a Chinese yuan, because they're having trouble too. But if they convert those, they have to convert a lot more money into one US dollar. So it makes our stuff more expensive. So it actually hurts our economy. But that's what the Fed's trying to do. And I elaborate on this in just a moment here. But the Fed is trying to slow down the US economy. So they are purposely making our stuff more expensive in foreign markets because it kind of slows the inflation rate. If people were buying all our stuff like they were, a few years ago, then the inflation is going to get out of hand again. So they're trying to temper the inflation by slowing down economic activity for U.S. goods. Of course, on the other hand, the US dollar, by the way, I showed you these two limits here, the extremes. July was kind of the low of we called it the COVID low in the US dollar, went down to like 88 cents. So the US dollar at that time was only worth 88 cents. Today it's worth $1.12. That doesn't sound like a lot, but that's a huge increase from where it was, and it does make our stuff more expensive in foreign markets. So if you're an exporter, if you're Harley Davidson and you want to sell motorcycles to somebody in Asia, you're not going to sell many motorcycles because you have to add on the additional at this point there's what 26 cents or 25 cents difference between the value of a dollar where it was and where it is now. So you have to add that to the price of a motorcycle. So if a motorcycle was going to cost you, let's say $15,000, well, now you're going to have to pay maybe $25,000 for that same motorcycle just because of the difference in the dollar. So a lot of people in Japan or Korea or somewhere else come along and say, never mind, I'm not going to buy that U.S. motorcycle. Maybe I'll buy another one, or maybe I'll wait for the dollar to come down in value so I can kind of do something different. I do have a train in the background, guys, so I hope it doesn't bother you. Hopefully you can't hear it. But that's what's happened with the U.S. dollar lately. The higher dollar does slow down the economy because it does make our stuff more expensive. And of course, when things cost more, people, I don't care whether it's foreign people or American people, people buy fewer things, right? And I was talking about, I couldn't remember if it was a 26% increase or a 28% increase. It was a 28% increase. So anything anybody buys in a foreign country that's an American product is going to pay 28% more for that thing than they would have had they bought it back in 2021. So just over a year, prices have gone up dramatically for U.S. products. It's a direct reflection of what the Fed's trying to do with interest rates. Just a couple of notes there. A higher dollar makes the American exports much more expensive, driving down demand for American products. And again, that's what the Fed's trying to do. The Fed wants a stronger dollar to fight inflation. Of course, the effect of this is to reduce corporate earnings. If Harley Davidson or General Motors ends up selling fewer cars because people aren't going to pay the additional 28% premium for the vehicle, then of course they're going to sell fewer cars. And if they sell fewer cars, of course their corporate earnings or their profits come down. So that's why we talk about whenever the Fed goes through these tightening procedures, you kind of risk a recession, and that's what the Fed's risking. Now, I think the Fed's already, and I think it's clear the economy's already in recession. It's not even arguable, but still, the more the Fed keeps doing this, the worse a potential recession could be, because our stuff gets so expensive, the rest of the world just simply says we're not buying any American products. A weaker dollar makes U.S. exports cheaper and foreign imports more expensive. So people would tend to buy our stuff and not some other country's stuff. For example, again, going with Harley Davidson, for example, if there's a $15,000 motorcycle out there, but the U.S. dollar is only 88 cents, that motorcycle, you might be able to buy that $15,000 motorcycle maybe for 10,000. And I'm just making numbers up. It's not the exact numbers, but still, you could save a lot of money on the motorcycle simply because the value of the U.S. dollar is lower. So at the end of the day, the value of the dollar has a big impact on economic activity, both here in the United States and around the world. As an economist, I'm one who prefers the lower value dollar. I don't like to see it at 88 cents, by the way. That was too far. Part of that was from the COVID part, but it also had something to do with Donald Trump, because Donald Trump was trying to lower the value of the dollar. He understood basic economics, what a lot of politicians don't. Most economists understand that if your dollar, or if your currency, I shouldn't say the dollar necessarily, but if your currency is weaker against other currencies, you're going to sell more stuff to the rest of the world. That's how China has become such a powerful economy. Now they artificially manipulate the value of their currency. They do it illegally. No country is supposed to manipulate their currency. I'm going to show you in a moment that there are countries that do that. But in general, if you're going to do it, you have to announce it to the other country, and you have to kind of give everybody an idea of what you're trying to do. But of course, China does what they want. China never come to anybody and say, hey, we're going to devalue our currency. The reason they want to devalue their currency is they want to make it cheaper for you to buy stuff from China than from any other country. China's in a little bit of a trade war with Vietnam, because if Apple makes iPhones in China, they might have to pay somebody in China. And again, I'm just making up numbers. They might have to pay them $10 an hour to make iPhones, whereas in Vietnam, maybe they can get them to make iPhones for $5 an hour. So the value of the difference in the valuations from one country to another might make Apple come along and say, hey, it's better for us to get phones made out of Vietnam than in China. So how does China keep Apple in China? they lower the value of their currency. So you can't necessarily lower somebody's wages, but if you take that $10 an hour wage, but you devalue the currency, and it might be a net increase, or it might be a net result, for example, that somebody in China is only getting $6 an hour. So it's still more than what somebody might be getting in Vietnam. But Apple doesn't have to build new plants in Vietnam. They don't have to go through all of those um, cost of building and research development, and we call them capex expenses, capital expenditures. So they don't have to do all those capital expenditures. So they'll pay an extra a dollar an hour to somebody in China by with a devalued currency, as opposed to getting that same labor a little bit cheaper in Vietnam without having to do all that capex expenditures. So that's the stuff that kind of goes on in the real world. It's illegal. It's not supposed to happen, but China does it, has always done it, and they've never even balked at it. You can look at them, you can accuse them right in their eye, and they don't care. So at the end of the day, um, that's the kind of stuff that goes on with a weaker dollar. So we generally like a weaker currency, not really weak, but a little bit weaker. Makes our stuff more palatable to other countries, and it makes their stuff a little bit more expensive in the United States. So that's what Donald Trump wanted, by the way. He wanted Chinese goods to be a little bit more expensive here in the United States, so that when you went out to buy a pair of shoes, you would think about maybe buying an American-made pair of shoes as opposed to a Chinese-made pair of shoes, in the hopes to kind of spur economic activity in the United States at the expense of the Chinese. These kinds of wars rarely ever work out, by the way, and we're going to get evidence of this very soon. What I mean by that, Japan and South Korea. So Japan and South Korea are struggling right now on a couple of different fronts. Both of those countries they're economic powerhouses, especially Korea to me. Korea is an amazing story. As little as 40 years ago, Korea was just a backwards country for the most part. It's not completely true, but today they're a powerhouse. You think about all the manufacturing they do, LG, Samsung, and all this, and Hyundai, and all of that. Those two countries are powerhouses. The problem here is they don't have a lot of natural resources. Japan and Korea, relatively small countries. They don't have a lot of natural resources. They import almost all of their oil. And again, if oil has to be bought in U.S. dollars, Korea could be making lots and lots of cars and selling them all over the world. But to make those cars, they need oil. And to buy oil, they have to have U.S. dollars. So they always have some currency reserves. We just simply call them the reserves. Countries always have a certain amount of U.S. dollars on hand to pay for oil and to pay for gold and all the things you have to pay for in U.S. dollars. But when the dollar gets too high against your own currency, you have to defend your currency. And for the first time in a very long time, I think it was 1986 was the last time Korea had to do it. It was 1998 maybe that Japan last had to do it. But they recently had to defend their currencies. How do you defend your currency? Well, you go into the Forex market, that's the foreign exchange market, and you sell US dollars and buy your own currency. So what Japan did, let's just look at Japan first. Japan sold $19.35 billion worth of US dollars. Now that comes out to 2.8 trillion yen. So their yen is roughly 145 to the US dollar, give or take. It bounces around a little bit. I think the last couple of days it's kind of going at 144, 143 type of thing. But anyway, they've sold $19.35 billion of US dollars to get some Japanese yen back in the system. Now, again, keep in mind in the world of finance, whenever you sell, there's a lot of sellers of something, prices for things come down. That's actually what caused the US dollar to come down last week. So we talk about that rally that happened it started on Friday of last week. That was when the Bank of Japan was kind of manipulating their currency. Now they did announce part of the G7, all the countries in the G7, of course Japan's in the G7. Those countries all have an agreement that if you're going to defend your currency, you have to announce it, and they did. So they told everybody, we're going to have to defend our currency. We're going to sell some US dollars. We're going to have to buy some Japanese yen. They did it, and it caused the US dollar to go down. And then, of course, Korea had to do the same thing. They had to defend their currency. Now, they don't have the yen, of course, they have the won. They sold $15.4 billion of US dollars. which comes to about $21.9 trillion, or a trillion won, I should say. The won, if you don't know the exchange rate, the won goes for about 1,420 something, 1420. I think today it was at 1424. It had been up to 1454, but it's come back down again. But what they're trying to do is they're trying to prop up their own currency. But to prop up their currency, they have to sell US dollars, which means they have less money on hand to buy oil and gold and all the other stuff that you need for business. So they're taking a risk here. And I've told you before, these things rarely work out right. So there's a very real possibility that Japan and Korea, even though they did what they thought they had to do, they may have shot themselves in the foot. If the US dollar continues to rise, they're going to get into a situation where their currency could collapse. Now, we haven't seen anything like this since about 1992. I don't know if you know who George Soros is, but George Soros kind of saw the same thing happening back in England in 1992. And what he did is he saw the writing on the wall. He saw that England had gotten themselves into such a bad position by selling their pounds, or I'm sorry, buying pounds and selling gold and stuff, that he knew that they were going to have to defend their currency big time. And he shorted the British pound, and that's how he became such a wealthy man. Of course, he uses that money for evil in my mind, but at the end of the day, that's how he did that. It's how he accomplished his goal of becoming a billionaire by basically forcing the Bank of England to its knees. Bank of Japan and Korea could end up in the same boat. I'm not saying they're going to, by the way. Hopefully, saner minds will prevail, and they will actually. Bank of Japan's doing it for different reasons than Korea. Bank of Japan is trying really hard not to raise interest rates. They're the one country that's keeping interest rates low. But the problem with keeping their interest rates artificially low is that they have to prop up their currency. And there's only so far, or there's only so much money that they can prop up their currency with, and ultimately they're going to have to raise interest rates. And again, once they raise interest rates, their economy goes even deeper into recession. I've kind of implied to you that, guys, that I think that when it comes to U.S. recession, we're already in a recession. I think it's going to be a relatively longer recession than normal, but it's not going to be really deep. Now, I could be wrong about that, but still, I don't think it's going to be deep. The rest of the world, I think, is different. I think we're going to see a deep recession for a lot of countries, especially for a country like Japan, which has stubbornly refused to allow interest rates to pop up, which would help their economy more than just simply trying to defend their currency. Defending your currency is usually one of those last-ditch efforts to try to save your economy. I think they've kind of they've gone too fast. Instead of doing something that might have had a better chance of working long term, they took their chance on this. And by the way, it's already kind of failed. When they did it originally, the Japanese yen, I think, was down to 140, and it's already back up to 144, 145 level. Again, the Japanese yen is still sinking against the U.S. dollar to some extent. It's not as bad as it was. I grant you that, but it has started rising, and so far it doesn't look like what they did has worked. And in my mind, they kind of wasted 19.3, well, let's call it 19.4, but $19.5 billion of reserves they've wasted on something that didn't really work. Korea is getting a little bit better out of it. Korea, their currency has popped a little bit, hasn't necessarily gone back down, but I think it's going to fail too. So at the end of the day, this is what's driving the market. So let me tie this all together. Let's go back to the question somebody asked on Facebook about, is it time to buy stock? While the U.S. dollar is this strong, while interest rates are rising, you cannot get into the stock market. I don't care what kind of rally there is. Now, if you want to play the rallies, you want to buy Apple stock and see if it goes from 140 to 150 and then get out, I'm all for that. That's trading. That's not investing. But that's speculative. That's not long. You're not going to do this long term. Now, there are some of you who are in your 20s and 30s. And for those of you who are in your 20s and 30s, and if you want to buy Apple stock here at 140, because I will tell you, I'm a big believer in Apple stock. All of my clients have some Apple stock. Apple's probably my favorite stock in the whole wide world. All of my clients have it. I have it. It's just one of those stocks that you recommend. even if Apple's at 140, 150 right now, I know that 10 years, 15 years down the road, Apple's going to be back to 200 to 500 to maybe $1,000 a share again. Apple's that kind of company. It has averaged 15% growth for just about forever. So that's a fantastic company. So if you want to do it long term, not a bad time. But remember, if you're doing it long term, you're going to do that through dollar cost averaging. So you're not going to use all of your money now to buy the Apple stock. You're just going to buy a little bit now, maybe a little bit next week or next month or something, or even a couple of months later to try to take advantage of those ups and downs in the market. So we call that dollar cost averaging. So dollar cost average into it if you're a long-term investor. But if you're like me, you're 10, 15, 20 years away from retirement, probably don't want to take those chances. Let's wait for the market to recover, to heal itself. It's going to heal. At some point, the Fed is going to stop raising interest rates. At some point, the US dollar is going to start coming down. When those two things happen, then we can start talking about let's get back into the market and try to find some good stocks. Until then, I think we stay on the sidelines. All right, guys, I think that's all I had for this meeting. I actually went a little longer than I thought I was going to do, but like I said, we'll be back to trading full time next week. Until then, we'll see you later. And again, guys, if you have any questions, I know during these recordings like this, you don't get a chance to ask me a question live, but if you have questions, you can always put them on Facebook, like what somebody did earlier this week. You can do it on YouTube. Of course, you can send me an email at those email addresses I gave you. So you can get a hold of me. We can talk about it. If there's a stock you're thinking about, there is a stock I'm actually thinking about. It might be a good buy. It's hard to kind of get it done, and I wanted to do the write-up on it last week. Of course, the storm took care of that, but I'm still kind of bullish on a stock out there. I'll tell you what it is in probably our next meeting. Not necessarily saying it's time to buy it yet, but it is something to think about because it's got a drug on it. It's a drug company. It's got a drug on the way that I think is going to revolutionize obesity in America. So we'll talk about that next week. I'll give you a heads up on that. And until then, we'll see you guys later. Enjoy your weekend, and we'll see you next week. Thanks, guys.